Welcome back to the Deep Dive.
Great to be here.
Today, we're digging into Northpointe Bank shares NPB, focusing on their Q3 2025 earnings call.
Right. And it's a really interesting one. You've got this bank post-IPO really trying to scale up.
Yeah, with these specialized lending products, better funding.
Yeah.
It's quite the strategy.
Exactly. But our job today, really, is to get past the prepared remarks. What's really driving things?
And what's the deal with the market reaction? Because that's the puzzle here.
That's the core conflict. The results looked, frankly, fantastic, but the stock didn't reflect it.
Not at all. So is the market seeing something we're missing, or is this just sector noise dragging a good name down?
That's what we need to figure out.
Okay, so let's jump right into the facts, the headline numbers.
They'll ram on us.
All right, JIC EPS came in at $0.57. Net income, $20.1 million. Solid.
Solid start.
But here's where it gets impressive. Return on assets, ROA, 1.34%.
Okay, that's strong for a bank right now.
And the return on tangible common equity, ROTCE,
Brace yourself.
15.41%.
Wow. Okay, 15.41%. That's top tier, especially now.
Absolutely premier metrics.
Yeah.
But like you said, the market reaction.
Yeah, the stock closed down 1.2%, right, to $16.65.
Exactly. So you post a 15 plus ROTCE and the stock dips.
It just screams disconnect. The broader regional bank fear, that whole sector drag, must be acting like a massive anchor here.
It feels like the market's just not giving them any credit for execution. Zero benefit of the doubt.
None. So let's unpack why they're executing so well. The growth engine.
Right. This isn't your standard commercial lender. It's all about these specialized high-yield areas.
Primarily that mortgage purchase program, the MPP.
The numbers there are kind of staggering. They funded $9.8 billion in loans in Q3.
Billion. With a B. That's the highest quarter they've ever had.
Ever. So the immediate question is, how do you scale that fast without, messing up on quality or margins?
And that's the key question, isn't it? It comes down to the niche. They're playing in specialized non-conforming mortgages, stuff bigger players might miss.
Allows them to get better yields.
Exactly. The average yield on these MPP loans is 7.0%. If you include fees, it's 7.30%.
Okay, that's a hefty yield. That definitely helps protect things.
It's structurally protective, and they're managing the balance sheet aggressively, too.
Yeah, MPP balances ended Q3 at $3.4 billion. That's up $473 million from Q2. Huge jump.
Huge jump, and $1.7 billion year over year. But they're not just holding it all, they're using participations.
Right. Explain that for folks listening, because that's sort of the magic behind managing this growth, isn't it?
It really is. It's about capital efficiency.
Yeah.
They originate the loan, book the nice fee income up front, and then they sell off pieces, participations, to partner banks. So they mentioned they have 12 partners now.
12 partners. So they keep the relationship, some income, but move the bulk of the loan off their books.
Precisely. It lets them recycle capital incredibly fast, originate, sell, keep the ratios healthy, go originate more.
And that's how they hit their full year 2025 growth target already, the one from the IPO.
In the first 9 months, they didn't just meet it, they absolutely blew past it. They're sprinting.
Wow. Okay, so that model, high yield niche origination plus efficient capital distribution, that's the core.
That's the core. And it's not just MPP. They're all in one product, the AIO.
Those first lien and OULOCs?
Yeah, those grew 23% annualized. Also high quality, sticky consumer loans.
So the asset side looks strong, high yielding.
Fundamentally sound. Which brings us to the net interest margin, the NIN.
Which is where so many banks are getting squeezed right now.
But not Northpointe. Their NIN actually expanded, up 3 basis points from Q2 to 2.47%.
Expanded. In this environment, how?
It's not luck. It's that structural defense we talked about. It's the balance sheet strategy working.
Explain that. Is it just rates rising, or is it that mix shift?
It's the mix shift. It's deliberate. As older, lower-yielding legacy mortgages run off, they're systematically replacing them with these new, higher-yielding MPP and AIO loans. That constant remixing, that portfolio engineering is shielding the margin.
While costs are rising elsewhere. Makes sense.
And they're doing it efficiently. The efficiency ratio held steady at 53.38%. So discipline alongside the growth.
Okay, asset side protecting NIM, that's huge. But what about the other side? The funding, deposits.
Yeah.
Costs there can kill you.
And that's where they had, I'd say, a really significant win in Q3.
Oh, yeah. What happened?
Total deposits grew nicely, up $296 million to $4.77 billion. But here's the kicker.
Go on.
Most of that growth, over $300 million, came from bringing on a new core custodial deposit relationship.
Custodial deposits, so like stable, low-cost money.
Exactly. Interest-bearing demand deposits, DDA. Not expensive, flighty brokered CDs. This is sticky stuff.
Wow, okay. That sounds like a potential game changer for their funding stability. What did that do to their wholesale funding reliance?
Knocked it down significantly. The wholesale funding ratio dropped from over 70.7% down to 67.6%.
That's a big move in one quarter.
It's critical. Reducing reliance on wholesale funding is priority number one for a lender like this. It stabilizes their cost of funds, lets those high asset yields really shine through to the bottom line.
And management knows this is key.
Oh, yeah. They hammered home that growing these non-broker deposits is a major strategic focus. And this quarter shows they can actually land these big relationships.
Okay, so growth engine firing, margin protected, funding improving. Let's talk risk, credit quality. Is this growth coming at a cost?
That's always the fear, right? Especially with this kind of speed. But management pushed back hard on that.
How so?
They kept emphasizing almost everything is backed by 1 to 4 family residential real estate. Homes, not office towers or anything exotic.
And it's spread out geographically.
Widely dispersed, no major concentration risks in one troubled area.
And did the actual credit metrics back that up?
They did. Total delinquencies actually decreased by about $4.6 million from Q2. Things got better.
Delinquencies went down. Interesting. What about charge-offs?
Net charge-offs were up a bit, came in at $977,000 for the quarter. That annualizes to about 7 basis points.
7 basis points. How does that compare?
Still very low, historically speaking. Management called it very strong. And importantly, they said about half of that Q3 number came from just 2 specific isolated mortgage charge-offs.
Okay, so not like a broad deterioration, more like a couple of one-offs.
Exactly. Doesn't suggest any systemic weakness bubbling up in the portfolio.
All right, that gives some comfort on the current state. What about looking ahead? Guidance. Let's start with NMA. What are they expecting?
They're guiding for NIM to stay roughly in this range, 2.45% to 2.55%.
Flat to slightly up from here.
Yeah, they see Q4 maybe at the lower end of that, but for full year 2026, they're aiming for the higher end, closer to 2.55%.
Okay, but what's baked into that 2026 number? Any assumptions?
Big assumption. Interest rates. Their guidance assumes the Fed cuts rates 4 times next year, 25 basis points each quarter.
Whoa, okay, 4 cuts in 2026. If the Fed stays higher for longer.
Then hitting that 2.55% IM gets much tougher. That's a key risk to watch.
Definitely. And what about loan growth? Still ambitious.
Very ambitious. For MPP, they're targeting $4.1 to $4.3 billion in balances by end of 26.
On top of what they participate out.
Right, plus another $300 to $500 million participated out on average. And they actually increased the guidance for the AIO loans.
Oh, really? To what?
Targeting $900 million to $1.0 billion by year-end 26. So, yeah, still full steam ahead on volume.
Okay, growth targets are high. What about the cost to support that? Expenses.
For Q4 this year, they expect non-interest expense to be pretty similar to Q3.
Flat finish to the year. And for 2026.
Guidance is $140 to $144 million for the full year.
So expenses are going up next year. What's driving that?
It's mostly growth-related, not inefficiency creeping in, higher variable comp because of the mortgage volumes.
Makes sense. More loans, more commissions.
Exactly. Plus normal merit increases, and then the ongoing costs of just being a public company, building out infrastructure, risk management, all that.
Standard stuff for a scaling company.
Pretty standard. Oh, and they did call out one specific item this quarter, about $935K as an expense from an old legacy SARS plan tied to the stock price being higher than Q2. Just shows how comp can fluctuate.
Right. Now let's get to what feels like a really big potential catalyst, the capital optimization plan.
Yes. This is management actively pulling levers. Financial engineering, really.
What's the plan exactly?
They announced they're going to call their series a perpetual preferred stock, about $77 million worth, before year end.
Okay. Call the preferred and replace it with what?
New subordinated debt.
Why do that?
Because that preferred stock is expensive capital. It likely carries a high fixed dividend rate. Subordinated debt, especially newly issued, should be significantly cheaper.
So swap expensive capital for cheaper capital, pure arbitrage.
Pretty much. It optimizes the capital stack, saves them meaningful money on an annual basis.
And that flows right to the bottom line.
Directly accretive to EPS, starting right away in 2026. It's a mathematical win.
Even though there's a cost to do it, they mentioned a one-time hit.
Yeah, there's a $3.2 million expense in Q4 this year to execute the call. But think of it as investing $3.2 million to buy a stream of higher future earnings.
Management buying future EPS growth. Got it.
It's a smart move designed to boost shareholder value and maybe, just maybe, convince the market they're serious about returns.
Which brings us back to where we started. This disconnect.
Yeah.
Great execution, improving funding, smart capital move. Stock goes down.
Context is just crucial here. That slight dip for NPB happened while the whole regional bank sector, the KRE ETF, was getting hammered over the past month.
So NPB is just caught in the undertow. High beta to this sector.
Completely. Macro fear is just overwhelming the specific company story right now.
So what are the catalysts that investors should watch?
Near term. Simple stuff. Keep paying the dividend, 0.025 pale soon. And definitely execute that preferred stock replacement before year end. That's tangible.
And longer term.
It's all about proving their model is different. Can they keep growing those custodial deposits? Can they really separate themselves in the market's mind from the generic troubled regional bank narrative? That's the multi-quarter story.
Okay, that sets up our next segment perfectly. The part where we toss caution to the wind.
Where we offer up an outrageous, but maybe, just maybe, plausible trade idea.
This is not financial advice. Repeat, not financial advice.
Definitely not. But look, the thesis here writes itself, doesn't it? You've got NPB executing incredibly well.
15 plus ROTCE.
Right. Trading at a discount, basically, because it's in a bad neighborhood, the regional bank sector.
But its house is actually really nice. Unique model, 7% yields. Improving funding.
And that upcoming EPS boost from the capital optimization, all these internal strengths should, theoretically, allow it to break away from the pack.
Decouple from the KRE.
That's the bet. So the outrageous trade idea,
let's hear it.
It's a relative value play. You go long Northpointe bank shares, NPB, and you go short the regional bank ETF, KRE.
Long the specific execution story, short the troubled sector.
Exactly. You're betting that NPB's internal momentum, the high yields proving resilient, the cheaper funding kicking in, that capital optimization hitting the bottom line will finally force the market to recognize its strength relative to the broader index.
Betting that quality eventually wins out over sector fear.
That's the essence of it. Betting on divergence.
A bold play. Okay, let's wrap this up. Key takeaway from Northpointe's Q3.
I mean, robust growth, really strong return metrics, all driven by that specialized lending focus, and crucially, that big win on the funding side with custodial deposits.
But the market's still skeptical, overwhelmed by the macro noise.
Completely. Management laid out a clear path, though. Aggressive growth targets for 26, that clever capital move.
Which leaves us with the final thought for you, the listener.
Yeah, think about this. You've got management guiding aggressively for MPP and AIO growth next year. You've got this guaranteed EPS boost coming from the preferred stock swap. Is that combined internal momentum going to be enough?
Enough to finally break free from that sector drag. Could this skepticism actually be masking a real buying opportunity the fearful market is missing right now?
That's the multi-million-dollar question, isn't it?
Something to ponder. Thanks for diving in with us today.
Always a pleasure.
We'll catch you on the next Deep Dive.